On January 28, 2026, two Federal Reserve governors voted against the majority decision to hold interest rates steady. That's the first time two Fed board governors have dissented in the same meeting in over 30 years. Regional bank presidents dissent fairly regularly, happens a few times a year, mostly symbolic posturing. But governors? Governors are the inner circle. They sit in Washington. They have permanent votes. They're handpicked by the president and confirmed by the Senate. When two of them break ranks simultaneously, it means the consensus inside the most powerful financial institution on earth is fracturing. And when the Fed fragments, markets don't know which signal to follow. That creates a very specific kind of danger for your money. My name is Alex, and I've spent the last decade tracking central bank policy and monetary data so you don't have to. I read Federal Reserve transcripts, dissent histories, and FOMC statements the way normal people scroll social media. If understanding where the economy is actually headed matters to you, make sure to hit that subscribe button and give this video a thumbs up if it gives you clarity the financial media won't. Before we dive in, what's your prediction? Do you think the Fed cuts rates in 2026 or holds them where they are? Drop your answer in the comments. I'm genuinely curious where this audience stands. Here's what I'm going to show you. The January meeting wasn't just another policy decision, it was a fracture point. And the historical pattern that follows Fed division like this tells you exactly what kind of volatility is coming and where the risk actually sits. By the end of this, you'll know what to watch, what it means for your money, and how to position yourself before the next Fed meeting in April. Now, let's talk about what actually happened on January 28. The Federal Open Market Committee voted 10-2 to hold the federal funds rate at a range of 3.5 to 3.75%. That's not the story. The story is who voted no. Sriram Maran and Christopher Waller, both governors, both wanted a 25 basis point cut. Both were overruled. Here's what makes this unusual. The FOMC has 12 voting members at any given meeting. 7 of those votes come from the Board of Governors in Washington. The other 5 rotate among the regional Federal Reserve Bank presidents. Cleveland, Philadelphia, Dallas, Richmond. Those presidents dissent all the time. It's part of the show. Regional presidents represent local economic conditions, and they use dissents to signal their district's concerns. It's theater, mostly. But governors are different. Governors are appointed for 14-year terms specifically to insulate them from political pressure. They don't represent a region, they represent the institution. When a governor dissents, it's not regional posturing. It's a fundamental disagreement about the direction of monetary policy. And when two governors dissent in the same meeting, it signals a collapse of internal consensus. The last time two Fed governors dissented together in a single FOMC meeting was 1993. We're talking over 30 years ago. That's how rare this is. And the January meeting wasn't even the most divided recent decision. In December 2025, the Fed had 3 dissents, the most since September 2019. But December's dissents included regional presidents. January's dissents were both governors. That's the distinction that matters. Now let me tell you why Maran and Waller wanted to cut rates, because their reasoning tells you what fault line is opening inside the Fed. Waller cited labor market data, specifically private payroll growth. According to Waller's analysis, private sector job growth has slowed to what he called stall speed, the point where the economy isn't technically contracting yet, but it's no longer generating enough momentum to sustain itself. Stall speed is the economy's equivalent of a plane losing lift. You're still in the air, but you're about to drop. Maran's reasoning was more structural. He's been pushing for rate cuts since September 2025. January was his 4th consecutive dissent, 4 meetings in a row where he said cut rates and the majority said no. That's not a one-time disagreement. That's a sustained policy conflict. Maran's argument centers on forward-looking risk. He believes the Fed is waiting too long to ease policy, and by the time the labor market visibly weakens, it'll be too late to prevent a deeper slowdown. He wants the Fed to cut preemptively. The majority wants to see more evidence first. Here's the problem with that. The majority, led by Jerome Powell, removed language from the January statement that had previously acknowledged risks to the labor market. The December statement said the labor market has generally eased. The January statement said the economy is on solid footing and the unemployment rate has stabilized at a low level. That's not a minor edit, that's a narrative shift. The majority is saying the labor market is fine. Maran and Waller are saying it's not. And they're both looking at the same data. What I'm about to show you next is the thing that took me years to understand about how the Fed actually works, the part that most people never hear about. Stay with me. The Federal Reserve operates on consensus, or at least it's supposed to. The chair doesn't dictate policy, the committee votes. But here's what academic research on Fed decision-making shows. A 2023 paper from the St. Louis Fed analyzed 40 years of FOMC dissent patterns and policy outcomes. The conclusion: the chair's preferred policy almost always prevails. Not because the chair has veto power, but because the appointment process selects for ideological alignment. Presidents nominate governors who think like the administration wants them to think. The Senate confirms governors who won't rock the boat too hard. By the time someone becomes a Fed governor, they've already been filtered for consensus-mindedness, which makes sustained dissent extremely unusual. When a governor dissents once, it's a signal. When they dissent 4 times in a row, like Moran, it's a rebellion. And rebellion inside the Fed means one of two things. Either the dissenter has access to data the majority is ignoring, or the majority has a political reason to delay action. Neither scenario is comforting. Now let's put this in historical context, because dissent patterns inside the Fed are actually predictive. During the late 1970s and early 1980s, the stagflation era, FOMC dissent spiked sharply. In 1979 alone, there were 23 dissents across the year's meetings. Compare that to 2015 through 2019, when there were years with 0 dissents. When the Fed agrees, it's because the path is clear. When the Fed fractures, it's because the path is unclear, and markets hate uncertainty more than they hate bad news. The last period of sustained Fed division was 2018 through 2019. That period ended with the Fed cutting rates 3 times in 2019 after hiking 4 times in 2018. The whipsaw confused markets, and the S&P 500 had its worst December since the Great Depression in 2018 before recovering in 2019. Division creates volatility, and we're entering another period of division right now. If you've made it this far, you're already ahead of 90% of people who just react to headlines without understanding what's actually happening inside these institutions. But don't stop now, because the next part is where this gets directly relevant to your money. Here's what makes the current division even messier. On January 32 days after the divided FOMC vote, President Trump nominated Kevin Warsh as the next Federal Reserve Chair. Warsh is set to replace Jerome Powell in May, pending Senate confirmation. And Warsh has a very different track record than Powell. Warsh served on the Fed Board of Governors from February 2006 to March 2011. He was one of the youngest governors ever appointed, at 35 years old. During the financial crisis, Warsh was a key architect of the Fed's emergency lending programs. He supported aggressive intervention to stabilize markets. But after the crisis, he became one of the most vocal internal critics of the Fed's quantitative easing programs. He warned that keeping rates too low for too long would create asset bubbles and distort market signals. In other words, historically, Warsh has been a hawk, someone who favors higher rates to control inflation. But here's where it gets interesting. In recent months, Warsh has publicly aligned with calls for lower rates. He's argued that the Fed has over-tightened and that restrictive policy is now doing more harm than good. That's a significant shift from his historical stance. And it puts him closer to Miran and Waller's position than to Powell's current majority. So here's the scenario we're walking into. Powell's final FOMC meeting as chair is likely April 29, 2026. That meeting will set policy for the next 6 weeks. Then Warsh takes over in May, and the entire tone of Fed communication shifts. Markets are trying to price in 2 different Fed regimes simultaneously: Powell's data-dependent caution and Warsh's potential pivot toward easing. That's why volatility is spiking. Nobody knows which Fed they're trading. According to CME FedWatch data as of early February, markets are pricing in at most 2 rate cuts in 2026, with the first possible cut coming in June. That's after Warsh takes over. The market is essentially saying Powell won't cut, but Warsh might. And if that's the case, then everything between now and May is a waiting game. But here's the part that should concern you. The Fed doesn't cut rates because the economy is doing well. The Fed cuts rates because something is breaking or about to break. If Warsh cuts in June, it won't be because he's generous. It'll be because the data forced his hand. And the data Moran and Waller are already citing labor market stall speed. Forward-looking risks suggest the break might already be in motion. Let me tie this together, because when you see how these pieces connect, everything changes. The Fed is divided. 2 governors are pushing for cuts. The majority is resisting. The chair is about to change. The new chair has a history of hawkishness but is currently signaling dovishness. And the labor market data is starting to crack. That's not a stable setup. That's a powder keg. Here's what you need to understand about how this affects your money. When the Fed is divided, markets don't get clear signals. And when markets don't get clear signals, they overshoot in both directions. We saw this in 2018. The Fed hiked rates 4 times while internal dissent grew. Markets tanked in December. Then the Fed pivoted, cut rates 3 times in 2019, and markets ripped higher. The people who got hurt were the ones who panicked at the bottom or chased at the top. The people who survived were the ones who understood the Fed's internal conflict and positioned for both outcomes. Right now, you're in a similar spot. The Fed might hold rates through Powell's tenure and then cut under Warsh. Or the majority might capitulate before Powell leaves if the labor data deteriorates faster than expected. Both scenarios are possible, and your positioning needs to account for both. Here's what that means in practice. If the Fed holds rates and the economy stays stable, risk asset stocks, particularly growth stocks, can continue to grind higher. If the Fed cuts rates because the labor market is weakening, that's not bullish. That's the Fed chasing a slowdown. In that scenario, defensive positioning matters. Bonds, stable dividend payers, cash equivalents. You want to be liquid, and you want to avoid the highest multiple, most speculative parts of the market. The tell will be the labor data. Specifically, watch the monthly payroll reports. Not the headline number, that's noisy and gets revised constantly. Watch private payroll growth and watch the revisions to prior months. If the 3-month average of private payroll growth drops below 100,000 jobs per month, that's stall speed. That's what Waller is worried about. And if we hit that number before May, Powell might be forced to cut before he leaves. If we hit it after May, Warsh will cut early in his tenure. Either way, the cut is coming. The only question is timing. And timing determines whether the cut stabilizes the economy or confirms that it's already too late. Now let me show you why understanding Fed psychology matters more than just watching the data. Because the data is backward-looking. By the time the numbers confirm a slowdown, the slowdown has already started. But Fed dissent patterns are forward-looking. They tell you what the insiders are worried about before it shows up in the headlines. Moran has been dissenting since September. That's 5 months of sustained concern about the same issue. Forward-looking risk to the labor market. He's not reacting to current data. He's positioning for what he thinks is coming. And he has access to internal Fed models, regional surveys, and real-time financial conditions data that you and I don't see until weeks later in public reports. When a governor dissents 4 meetings in a row, he's not grandstanding. He's genuinely worried. Waller's dissent is newer, but more significant in some ways. Waller has historically been a moderate. He's not an ideologue. He doesn't dissent for political reasons. When Waller breaks from the consensus, it's because the data moved him. And what moved him was the private payroll data hitting stall speed. That's concrete. That's measurable. And that's the kind of signal that precedes recessions. The majority, Powell, and the other governors who voted to hold are betting that the labor market stabilizes at current levels. They're betting that inflation pressures remain contained and that the economy can handle current rates without tipping into contraction. They might be right, but if they're wrong, the window to act closes fast. We're in the home stretch now, and I need to show you how all of this works together as a system, because this isn't just about one Fed meeting. This is about a pattern that repeats every time the Fed fragments. The pattern works like this. The Fed holds rates too long because the majority wants more certainty before acting. Dissenters warn that waiting is a mistake. The data deteriorates. The majority finally pivots. But by the time they pivot, the damage is done. The economy is already slowing, markets have already repriced, and the Fed is playing catch-up instead of getting ahead. We saw this in 2007. The Fed held rates at 5.25% even as the housing market was visibly cracking. By the time they started cutting in September 2007, the subprime crisis was already metastasizing. They cut rates 10 times over the next 16 months, but it didn't matter. The recession was already inevitable. We saw it again in 2019. The Fed hiked rates 4 times in 2018 despite internal dissent and clear signs that global growth was slowing. By December 2018, markets were in freefall. The Fed pivoted, cut rates 3 times in 2019 and avoided a recession, but only barely, and only because they acted fast once they finally acknowledged the problem. The current setup rhymes with 2019 more than 2007. The financial system isn't fragile like it was in 2008, but the labor market is showing early signs of stress, and the Fed is divided on whether that stress is significant. If they're slow to respond, we get a shallow recession. If they pivot quickly, we might avoid one. But the division itself tells you the uncertainty is real. So here's what you do with your money right now. You don't panic. You don't make big moves based on one FOMC meeting. But you do start preparing for two-way risk. That means having cash available if markets sell off and opportunities emerge. It means trimming the most speculative, highest valuation positions that will get hit hardest if growth slows. And it means watching the data that the Fed is watching, specifically the labor market. The next major data point is the February jobs report, which comes out in early March. If private payrolls come in weak and revisions to prior months are negative, that increases the odds of a Powell-era cut. If payrolls hold steady, Powell leaves without cutting, and Warsh inherits a stable but uncertain environment. April 29 is Powell's final meeting. That's the date to watch. If he holds rates and hands off to Warsh with no cuts, the pressure is on Warsh to act quickly if data deteriorates. If Powell cuts in April, it's a signal that the majority finally capitulated to the dissenters' warnings. Either way, the leadership transition from Powell to Warsh in May creates a period of maximum uncertainty, and uncertainty creates volatility. Volatility creates opportunity if you're positioned correctly. It creates losses if you're caught off guard. Before I wrap this up, I want to know what's the next Fed-related topic you want me to dig into. The dollar's strength, the Fed's balance sheet, inflation versus deflation risks? Drop it in the comments. That's what this channel is for. You're not watching this video by accident. You're here because you understand that the financial headlines don't tell you what's actually happening. The Fed just gave you a signal. 2 governors broke ranks. That hasn't happened in over 30 years. The leadership is about to change. The data is starting to crack. And your money is sitting in the middle of all of it. 10 years from now, you're going to look back at early 2026 and realize this was one of those pivot points. The moment when the economy and the Fed's policy were out of sync and the people who paid attention positioned themselves correctly. The people who didn't are still wondering what happened. You're not most people. You made it to the end of this video. That puts you ahead. Now go watch the data. Watch the labor market. Watch what Warsh says in his confirmation hearings. And watch what the Fed does in April. Your future self is counting on the decisions you make right now.